Rebecca, you know, I find it so fascinating that all these global issues going on, everybody trying to decide what's going to happen with global trade, what's going to happen with tariffs. About 40% of your respondents are outside the U.S. They're equity investors. Tell me what they're looking at.
Sure. We surveyed 76 institutional investors globally this quarter, published our research online today. They're looking for continued deceleration. So earnings season is priced in for sequential deceleration, in line to worse than consensus estimates. And they're bracing for deterioration in free cash flow, deterioration in margins. So expectations are for a pretty bad quarter.
And if I had to summarize what I saw is that for U.S., they're still thinking 2.5% GDP was the highest percentage pick in terms of number, but yet recession in the next 20 months also was a high probability. And then through all of that, the biggest concern, of course, is trade. So they are optimistic about some issues regarding the U.S., but not necessarily multinationals.
Yeah, so they're coming into understanding that we are in a new normal. And this is a new normal, and they've wrapped their heads around that. And so it's all about expectations management. And so they've come to terms with the fact that global growth is slowing. And for multinationals, what I think there is a disconnect with regard to investors and what corporations will announcing is the second derivative of the cost cuttings. Last quarter, we identified over 3,600 companies globally that announced cost-cutting actions, 18% higher quarter over quarter, and 20% of those announced headcount reduction, layoffs. That will cycle through, and that's going to trickle through other sectors and to the consumer eventually.
Now, if all the concerns start to moderate, nothing's going to be binary when it comes to trade. If things improve, it will be a slow improvement. How will that affect some of the ultimate decisions of strategic money in the equity markets based on your survey?
Yeah, well, if you think about what corporations have done, right, they have basically realigned their financial positioning to this new normal. So cost cutting, we've seen a lot of CapEx reductions happening, demand, et cetera. That's all related. And so they do have the ability to continue to reinvest, which they are. You know, we're not talking about zero growth. We're talking about lower growth, decelerated pace.
It certainly seems as though one thing is for sure. The last couple of surveys, this one especially, they put so much strength in current management under the strained conditions. And the time we have left, explain why that keeps showing up.
Sure. I think management teams have gotten a lot smarter, at least the ones that we follow and work with. And they are ahead of the curve in terms of understanding what the ramifications are with tariffs. And they have addressed that through initiatives, cost cutting, et cetera. And I think they're going to be looking for, investors, strong balance sheets. Debt level sensitivity is at all-time high. And most investors that we survey are comfortable with less than 2 times net debt to EBITDA. That's going to be a huge topic. So management teams have reconciled their balance sheets. They're stronger. They're getting ahead of this. And, if we do see any type of catalyst that'll change, like a resolution on tariffs, they'll shift gears accordingly.